Welcome to Taking Stock. I'm Amanda Lang. Coming up on the show, a special look at trade in Canada, including how business is and should respond to threats from our biggest trade partner. And diversification is key for Canadian trade, but is that easier said than done? Plus, as the world rethinks free trade, where should Canada land? That's all ahead. But first, Canada needs to think about where and how it trades. Here's a look by the numbers. It's no secret that most of our trade goes to the U.S. Our exports were $439.6 billion in 2023. China was the destination for $22.6 billion. Japan, $11.6 billion. The UK, $10.5 billion. And Mexico rounds out the top five at just $6.5 billion. One thing a lot of those countries have in common is slower growth. The U.S. is tracking for GDP growth of 2.2% this year. Japan, 1.1%. The UK, 1.5%. Meanwhile, India, heading for 6.5% growth this year, represents a tiny part of Canadian exports, $3.7 billion in 2023, and we have yet to finalize a free trade deal there. But then we don't currently have a full free trade deal with the UK either, and the EU has yet to ratify our agreement with 10 countries among holdouts, creating uncertainty for business. Even so, the existing agreement with the EU has upped our bilateral goods trade there. It increased 65% since it was signed in 2016. A survey of Canadian businesses exporting to the UK and EU found that 1/3 said their main competition was businesses in those countries, but more than 1/3 said their offering was unique and had little local competition, and more than 1/3 said quality was the key differentiator for their success. It reinforces the notion that businesses that export innovate and create better products at home, too. When it comes to the ease of exporting to the U.S., 34% of businesses said quality was their key competitive advantage. Almost 21% said the weaker Canadian dollar was the secret, hardly a recipe for innovation and efficiency. Whether Canada likes it or not, the U.S. is definitely changing the rules of the game on us. So how best to proceed? Roger Martin is former dean of the Rotman School of Management at U of T, author of several best-selling and foundational books on strategy, including When More Is Not Better. Roger, thanks for being with us.
Hey, it's a pleasure, Amanda.
And I choose that book among your many to highlight because it actually gets at this issue of, there is a limit on the benefits of free trade and globalization. And here we are. We may have arrived at that view politically. I wanted your thoughts on what a country like Canada should do, Roger, where our biggest trading partner doesn't want to dance with us anymore. What are our options?
Well, it's not an easy situation, as most Canadians know. I think Canada got used to a world in which there was free trade, and that was the foundational theory of the global markets. Free trade is better. And we poured, as of now, 77% of our exports into one country. And that, I've talked about this in the past in my policy, where that was never a good idea. Because that big country needed us way less than we needed them.
Right.
The U.S. is the world's biggest internal market. It only has 11% of its GDP as exports. 33% of Canadian GDP are exports. So we needed them way more than they needed us, and we assumed things wouldn't change.
So it seems to me that we have a couple of options now. If we can't trade the way we have in the past with the U.S., we talk about exporting to different markets, and we talk about manufacturing more here, being more self-sufficient. Are those two good options for a small country like Canada?
The problem is exports, right? The problem is not people who would like to export to us. There's, anybody in their cousin wants to export to a nice rich country like Canada, including the U.S. The biggest problem is we haven't diversified our exports at all, or very little. And we're just going to have to reach an accommodation with the U.S. The big countries of the world are going to charge, if you will, for access to their giant markets to a greater extent than they have in the past 50 to 75 years. China already has.
Right.
China says, oh, you've got to create a joint venture in our country. You've got to let us steal all your intellectual property. That's what people are paying for access for the Chinese market. The United States has said, you don't have to pay anything for access to our market. And they've stopped thinking that that's a great idea. And so we're going to have to pay access to that market, whether it's tariffs or other things. So figuring out what's the best deal we can strike there and getting to work on diversifying our export destinations is what we've got to do.
And when you think about that, the best deal, I think that's a very refreshing view, because I think a lot of people are looking back longingly at what has been. If we have to pay for access to that big market to the south, what does the best deal look like in your view? Is it just accepting that there's some form of kind of tariff barrier between us?
Well, I think so, but I think Canada's got to be a little more clever about kind of what it exports to the United States. So the big countries, I think, in the coming era, now that we've ended the era, the golden age for small countries, they are going to be most sensitive to the industries in their own country that will be replaced by exports.
Right.
So when Canada replaces employment in the U.S. with its exports to the U.S. more intensively, right, then that's going to be more problematic. Like, I honestly think lumber is a less problematic export to the U.S. than steel, because it's displacing as many workers as you are, I think, in a traditional manufactured good.
Roger, so good to have your thoughts for this. Really appreciate your time.
Not at all. It's always a pleasure, Amanda.
Roger Martin is a former dean at the Rotman School of Management at U of T. Coming up, Canada's economy is highly dependent on a North American supply chain, but is that a strength or a weakness? Stay with us. For all the talk about diversifying our trade, there are a host of good reasons why Canadian businesses are so resolutely focused on the U.S., even at the expense of the domestic Canadian market. Daniel Tisch is president and CEO of the Ontario Chamber of Commerce. Thanks for being with us, Dan.
Hi, Amanda.
So let's start with this notion that we need to diversify beyond the U.S. We talk about this. We have talked about it for years and years. Ontario, of course, is somewhat unique in the sense that it's the engine of the whole Canadian economy, but very U.S. focused. What are the big impediments, in your view, as we think about trade more broadly?
Well, as I think about this, I mean, the challenge is, for Canada, I think the imperative is competitiveness over complacency and diversification over dependence on our largest market, even our largest market. And so there are a range of different issues. We're over-reliant on the U.S. market. The U.S. is obviously unlikely to be a reliable trading partner in the next few years. That's a very clear signal we're getting. Mm-hmm. It's also likely to be a period of policy instability in the U.S. And so, I think that for businesses, there are all sorts of barriers. I mean, part of it is obviously just getting, we've become very used to the easy access to the U.S. market. It's one of our great strengths, but now we're also seeing it become a weakness. So, I think there's a need for business to have financial stability and predictability. There needs to be access to trade resources, market intelligence, trade financing, logistical support, perhaps to reduce export risks. And more broadly, Canada and Ontario need a long-term industrial strategy. So that's looking at both our linchpin industries of today, but also the sectors we want to grow for tomorrow. So if you look at AI or life sciences, for instance, big sectors now, but we want strategically to grow them. If you look at mining, where the Ontario government's done, I think, an impressive job attracting historic investments, and the federal government too, historic investments in Southern Ontario manufacturing, such as the EV supply chain. Yep. But it's got to be matched with similar investment and an approach to building up the mines themselves in Northern Ontario and de-risking those projects.
There, of course, for reasons of just basic geography, there's a reason why the U.S. is easiest. Language and culture, laws, these are all things that make our businesses fluid in terms of trading back and forth. When we think about other options, what's the best form of support for business if we want to think about trade with the EU or trade with South America or even going directly to trade with Mexico? What could our governments do to back that up?
Well, generally, I think Canadian businesses need a bigger playing field, right? And so it's about investing in global trade expansion. It's about reducing our vulnerability to U.S. policies, and it's about finding new opportunities. So, I think the first step from government is, actually getting data that can drive business support decisions, right? So, let's triage our manufacturing base in particular. Let's understand what's most at risk because of overdependence on the US market. And that can lead to support decisions, right? Smaller businesses in particular, smaller manufacturers, they've got less flexibility to adapt to changing trade policies. So immediate financial support, it's not necessarily cash, and it's certainly not COVID style cash for everybody. It can also be tax incentives. It can also be assistance in understanding new markets and investing in trade diversification.
Right.
And as I said before, market intelligence, trade financing, logistical support. These are all elements, I think, of a smart business support strategy for that essential diversification.
I do want to hit on the trade barriers between provinces. There's lots of talk about renewed interest in lowering them, but they've been there for a long time. There's lots of vested interest that keep them in place. How do we see real progress being made here?
I'm encouraged that now there's real momentum around this issue. There's a sense that governments are actually listening, and it's a political priority across the country. For the first time, Ontario and all of the other provincial chambers of commerce, we co-signed a letter to our premiers saying, we will support you in bringing down these barriers, because we know some industries are going to object, and that's often been an issue.
We got to leave it there, Daniel. Great to have you with us.
Nice to be here. Thanks again, Amanda.
Daniel Tish is president and CEO of the Ontario Chamber of Commerce. If the threat of a more protectionist era on trade was a wake-up call in general, nowhere has it felt more strongly than for North American auto supply chains, which are deeply integrated. Linda Hasenfratz is executive chair of Linamar. Linda, thanks for being with us.
It's a pleasure.
So, of course, the auto sector is one that would be hit first and hardest and most deeply. As we contemplate sort of what might happen in a more protectionist era of trade, what can we do about that? Where does your mind go when we think about how integrated the supply chain is?
Yeah, I think the issue is the supply chain is so integrated that trying to, as some folks have said, unscramble the eggs is pretty difficult and pretty costly. So the idea of entering an era where we are going to have tariffs applied at every border crossing in North America would simply kill the industry. There's just no other way to describe it. I mean, we've got multiple border crossings throughout North America, Mexico, US, Canada, all three countries, back and forth. The idea of putting tariffs on every one of those border crossings, which for a typical part might be 6, 7, even 8 times that it is in some form crossing a border, which adds just a ridiculous amount of cost. I mean, we've had free trade between Canada and the US in the auto sector since the 1960s,
right,
and with Mexico since the 90s. I mean, this is decades of a supply chain in the making that to try to disassemble is incredibly costly and really makes zero sense when we've got something that works.
So all of that, of course, argues for, something more like the status quo prevailing. We did get this sort of shot across the bow, though, and we know a lot of Canadian businesses have started to think what they can do to protect themselves and how they could diversify into other markets. It's something that Linamar has already done. I mean, you've got global businesses. How hard is it, though, for Canadian businesses in manufacturing to think about something that's less geographically available than our big partner to the south?
Yeah, I mean, I think that I would encourage businesses to look to the world as their market. I mean, it's obviously tempting. We have the US right there. It's a huge market and there's lots of opportunity there. And I would absolutely continue to pursue that. I mean, to me, you're competitive, not just, obviously on your price, but also on the technology you're bringing to the table. So, if we continue to invest in innovation and technology, and we have great products that we've found ways to produce for lower and lower costs, we can obviously still be competitive. So it's not like this market is not going to be available to us. But at the same time, of course, there's global markets that are pretty exciting, and there's a lot of opportunity out there for growth. And also expansion outside of your core market, just as you've noted we have done. I mean, we've diversified from our automotive core into agricultural equipment, into access equipment through our company Skyjack. We make scissor lifts, boom lifts, and telehandlers. On the ag side, we're making harvesting equipment, tillage equipment, crop fertilization, seeding equipment under a variety of brand names.
Yeah.
All of which are Canadian based. So, there's a lot of opportunity to do that, to read across your processing capabilities into new industries.
So good to have you, Linda. Appreciate your time today.
It's my pleasure, Amanda.
Linda Hassifratz is Executive Chair of Linamar. Still ahead, a new way of thinking about trade could be an opportunity for Canada. Stay with us. Exporting to new, faster-growing markets seems like an obvious choice for Canadian business. So what are the big impediments to doing it? Dennis Darby is President and CEO of the Canadian Manufacturers and Exporters. Dennis, thanks for being with us.
No problem. Thanks for being here.
We talk a lot about diversification. Obviously, there's sort of an ease of going continentally. If we want to export to new markets or do more of the markets we're already hitting, what do we need to do?
Well, you said it right off the top. The ease really is a construct that we've done over the last 50 years, is to build most of our trade routes, whether it's road or rail, going north-south, and that has been the access to the world's biggest market. So of course that's where a lot of our focus has been, despite the trade agreements. What we have to do is actually improve our infrastructure going east and west, and that's not a simple thing to do. It's easy to say, but that's the issue, is we don't have the capacity at our ports or our east-west rail or even our roads, because of what I call silly differences of in jurisdictions around moving goods across the country. That's sort of one step, how to be able to get our goods to to east and west more efficiently.
So the infrastructure internally, there are some barriers to that. But let's assume we have the political will and we spend the money. That will create jobs and economic activity. After that, are there things that Canadian businesses need to do differently to think more broadly about foreign markets?
Right. So if you think about, so if you create that infrastructure, so the efficiencies that we have going north-south, we can, let's assume we can do something equivalently going east and west, whether it's in pipelines or roads or rail. That's fine. One thing that Canadian business and manufacturers have done is underinvest for years. And what that really means is our productivity. Are we as cost competitive as we should be? It's not been lost on anybody that over the last few years our productivity has gone down. So our output per worker is one example, GDP per capita. Now, that hasn't affected our ability to sell to the US, because the US, being that big market, has been able to take everything we could produce. So one step is we have to improve our productivity. We have to make those investments. We have to make sure that we are as efficient as we can, because if we're going to go compete with either European suppliers or Asian suppliers, we've got to be as sharp as we can possibly be. And that's not going to happen overnight, but that's something that is in our control as Canadians.
And should we be doing more thinking about value add? So processing here, manufacturing here. We export an awful lot of raw materials, and that's been to our advantage. Is there a different way to go in the future?
Well, of course, and of course, you're asking the right person. So CME is all about value add. So when we process ingredients or components or materials here, even when we semi-finish goods, that adds a lot of value. That increases the value of a raw material, in multiples. So absolutely, that's got to be our focus. How do we, we are good at manufacturing, many things, machinery, equipment. We're good at doing parts for aerospace and automotive. Well, those businesses and those exist in other parts of the world, including Mexico. We don't often talk about Mexico. How do we get goods to Mexico? Right now, Canada the NAFTA or the USMCA tends to more be one-on-one kind of trading. We don't trade a lot with Mexico relatively. That's another opportunity again. We could be competitive, if we work at it, to be in those value-added industries or value-added supply chains. So that's the ticket, is to move our value-added goods in both directions. And I think there's an opportunity. Again, it's something that we that was talked about at the summit with the Prime Minister last week.
Yep.
But really, it's a longer term approach. It's not something that someone's going to do, overnight.
Is there low-hanging fruit? I'm thinking particularly of our ag. Dennis, it was just Ag Day in Canada, and I was at an event. There's an awful lot of value add. We could be, instead of exporting mustard crops, we export specialty mustards. What kind of support do we need to give industry so that they start thinking that way?
We need to make sure that we have, the right investments, the right regulatory requirements, so people can make those investments in plants and equipment. It's a whole suite of things to say, okay, if we were sitting down and saying, okay, we don't have the world's biggest economy right next door, how would we do our best to maximize the value of what we sell to the rest of the world?
Dennis, so good to have you. Appreciate your time for this.
All right.
Dennis Darby is President and CEO of the Canadian Manufacturer and Exporters. Time for the takeaway and managing our own trade issues. For many years, Canada's system of supply management has irritated our trading partners. This closed system means the government manages how much dairy, eggs, or poultry is produced in Canada and how it will be priced. Instead of starting from the consumer and working backwards, how much milk do people want and at what price, supply management's goal isn't so much delivering low cost or innovative products as it is keeping the farms themselves functioning well. Farmers inside these systems do well, in some cases to the tune of millions. Advocates say that protects a way of life in Canada. It may keep our farms smaller, preserving a nostalgic view of the family farm. Does it make the product safer in some way? There's not much evidence of that. There is, however, lots of evidence over time that it makes the product more expensive. And then there's the impossible to know, the counterfactual of innovations that haven't happened because there just aren't the market forces that make innovation thrive. Given that there's questionable value to consumers, and given that if prices are higher than they otherwise would be, it hurts the poorest Canadians the most, it sort of makes you wonder why supply management gets a pass in Canada. Every party lines up to support it. Could that be because of the electoral map, which makes it impossible to win a federal election without Quebec and Ontario, where the vast majority of the beneficiaries of the system live? Whatever the reason, our politicians don't seem motivated to change it. But change could be heading our way nonetheless. Our trading partners may simply force our hand. The U.S. has raised access to our markets, meaning they want the opportunity to sell well-priced and high-quality products to us. But so has the U.K. and the EU. Nobody likes supply management, except, of course, the farmers who benefit. Changing it would mean compensating them fairly, by the way, as they've done with their systems in Australia and New Zealand. My takeaway, in a world that's less favorable to free trade, it's more important than ever to show our good faith. And protecting a few businesses at the expense of all consumers is hardly a good way to go about it. That's Taking Stock for this week. I'm Amanda Lang. Thanks for being with us.